Listen up, folks. Time could be running out to lock in a historic yield at public.com.
The Fed just did a rate cut a couple weeks ago. There's more on the calendar, so who knows how long these rates are going to last.
That might be great for you if the Fed is cutting, if you're in the market to buy a home. It's not great for the interest that you're currently earning on your cash. What's the solution? Possibly the public bond account. If you want to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds, you might want to act fast. Go to public.com/compound for more information. Michael, read the disclaimer.
Okay.
What are you on, your fucking emails?
It's over. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed, not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hello, everyone, and welcome to an all-new edition of What Did We Learn? I'm here, as always, with my friends Nick Colas and Jessica Rabe. They are the co-founders of DataTrek Research and the authors of DataTrek's morning briefing newsletter, which goes out daily to over 1,000 institutional and retail clients. They're also two of the smartest people I know. Nick and Jessica have their own YouTube channel, which you could find a link to in the description below. Hi, guys. How are we today?
Good.
Well, thank you. How are you?
I'm doing well. Nick, are you in an undisclosed location?
I'm in Memphis, Tennessee with the in-laws.
All right. Very cool. I wanted to start off with what's happening just generally speaking in the markets. If everybody's expecting a melt-up, which seems to be the case, can we actually still have a melt-up? Or are we ruining it for ourselves? Are we jinxing it? What do you think?
Oh, it feels like a bit of a jinx, but the market momentum is a very powerful force. And as we always say at DataTrek, never sell a new high.
Yeah. You guys note that investor confidence in the U.S. economy is extremely high. I would point out, I was looking at the polls right after the election, and everything that people said was wrong all of a sudden became right. And we stopped hearing about inflation and started hearing about robust growth. And it's the same data. And a lot of that quote unquote uncertainty has now turned into confidence. So I love the vibe shift. And I feel like no matter who somebody voted for, they should, I think, be happy that people are willing to say, for regardless of the reason, hey, the economy is actually really good right now. And maybe there are reasons to be a little bit more optimistic. What do you guys think?
They have to be happy with their portfolio returns since the election.
Right. You don't have to like everyone that was elected to every post, but that's what the money's for, is the way I like to put it. Can we talk about record low spreads?
Yes.
All right,
so,
Nick, why don't you cook on this?
A little show and tell here. This is corporate bond spreads over treasuries. And the basic math here is that a corporate issuer has to pay more to issue a bond than the treasury does. Treasuries are risk-free. Corporate bonds have some risk. This first chart shows investment grade spreads, the amount of basis points that a corporate issuer, a high quality corporate issuer, has to pay above treasuries. And you'll look at the right-hand side of that chart. We're now sitting at lows that we haven't seen since the mid-1990s. So corporations that are high quality investment grade kind of issuers, they're paying very little over treasuries relative to history for the privilege of issuing debt. And that tells us that there's a lot of confidence in corporate issuers and corporate cash flows and corporate earnings. And not just for this year and next year, but the average duration of these bonds is 8 or 9 years. So it's a very long tail, a very long projection of a lot of good news. The next chart shows you high yield spreads. And here the story is very, very similar. High yield spreads now are near record lows, again, back to the early mid-1990s, levels we have not seen before, even during the pandemic with all that stimulus coming through the system, even during the 2010s, which was a fantastic economic boom. Even in the 2000s, you have to go back a long way to see spreads this low. And it just tells you corporate bond investors, who are really kind of a quirky, risk-averse kind of cohort, they're seeing nothing but blue skies ahead for U.S. corporate profits, profitability, profit margins, and the economy. It's really a remarkable level of optimism.
Are they taking their cues from the stock market, or is this just something that's happening concurrently people feeling better about both stock market risk and bond market risk, or is there's some interoperability here, right?
It feels like a little bit of both. The reason we look at these corporate bond spreads is because they're not as skewed to tech as the stock market, especially the S&P 500. So the big corporate bond issuers are industrials and financials and consumer staples and discretionary, much more of a classic mix of what you would consider to be economically sensitive groups. And those are the groups where the bond spreads are extremely tight. So it feels like maybe 30% stock market. Hey, the S&P is trading at 22 times earnings. Corporate bonds must be a good deal here. But 70% is just this latent optimism that we're seeing that's just hitting record highs.
The S&P 500 financial sector, stock-wise, is up about 40% on the year. It's actually beating tech. It is the best performing sector of 2024. That is happening concurrently with a coming, we think, wave of deregulation, a continuation of the 2017 tax cuts, and interest rates falling. If all of those pieces of the puzzle fall into place, isn't the right question or isn't the right way to look at this like, well, why wouldn't people feel good about taking risks in the bond market right now?
Yeah, that's absolutely true. And I think directionally, absolutely correct. The question is, measured against history, we're now at levels that are extremely high. And it's not just the S&P 500. It's this much more risk-sensitive part of the market in corporate bonds. So totally fair that we'd feel good about taking risks. The question is it already 100% priced in?
So guys, that's my question. That's what I wanted to ask you. Isn't this the most dangerous time to be putting on risk? When everyone is calm and comfortable with taking risk and there's a lot of complacency, aren't those historically the breeding grounds for future trouble? Does that concern you at all?
Of course it does. The challenge is, and like we have another saying at DataTrek, the end of the world's a great trade, but you have to time it just so.
Maybe something between the end of the world and Goldilocks melt up, like maybe something somewhere in between.
I'd feel a whole lot more comfortable with spreads that were higher than here because it would feel like there's a sensible amount of risk taking versus excessive risk taking. And if you go back to that high yield chart, for example, you'll see that, spreads are now back down to 97 kind of levels. We continued to rally in the stock market through March of 2000, and high yield spreads did increase because first of an Asian and Russian debt crisis, currency crisis, and then the failure of long-term capital. So it's not like we can not see an unwind of this very high level of optimism in the corporate bond market and not see stocks continue to rally. Both can absolutely happen, but it would be more comfortable if spreads were higher because it would say investors are thinking about risk more appropriately.
I added this chart to the doc from Callum Thomas, and this is U.S. high yield credit spreads. So this is showing what you guys were showing, but these bands seem to be meaningful. So we're looking at standard deviations away from kind of the baseline for high yield credit spreads above treasuries. And when you look at this and you just look at the years on the x-axis below, just intuitively, like none of these periods of time of record low spreads coincided with amazing buying opportunities. And obviously some of them coincided with market tops, but not all of them.
Right. I mean, 97 was a pretty spectacular time to be long the S&P. And that's when, the line hits that yellow line at the end.
Oh, so you had to be long. You had
to be long. 97 with those record lows, you had to be long. You were going to get close to a double in the S&P through March 2000. So, but again, in 07, the next time it hits the level, not so good, obviously.
Yeah.
Yeah, you don't want to be George Soros who gets into tech stocks late towards the end of the 1990s stock market run and then get caught off guard and get creamed in 2000.
So I wanted to ask you guys, do you worry about this, maybe not right at this second being a Minsky moment, but developing into a Minsky moment? And for the audience, a Minsky moment is defined as the onset of a market collapse brought on by speculative activity that defines an unsustainably bullish period. Minsky was an economist who talked about these periods of time where everyone was so comfortable with risk that there weren't enough people hedging. There weren't enough people worried enough about the future. and kind of people being all in. And I just want to show you two charts really quickly to illustrate this. So these are the three stages of lending. So an economic recovery after a crash starts off with hedge borrowing, and then it gets into speculative borrowing, and then it gets into full-on Ponzi borrowing, and then you hit your Minsky moment where credit rolls over. Of course, equities go with them. The economy itself rolls over, and these are the next chart is just kind of some definitions. So I don't know if I don't think we're in the hedge phase, is what I wanted to ask you guys, where it's strict credit policies, investors favoring low risk activities, and sufficient levels of debt. The next phase, speculative borrowing, loose credit, borrowing rises, asset prices rise, everyone's got healthy returns, and the economy's booming. I sort of feel like we're there. The next phase would be the Ponzi phase. And if you talk to, some of our colleagues, especially on Twitter, they would say we're in the Ponzi phase and we've been for a while. How do you guys think about these stages? Is this like an important consideration to your work or not really?
It's a great construct because it links money creation through lending to the economy, and that's philosophically a very solid foundation for the right way to think about the market. As for trying to spot where we are in one of those three phases, we don't think very much about it, but we think about it in terms
right?
of it's subjective. We prefer to use, hence the name DataTrek. We prefer to use the data of things like over bond spreads to say, where are we, psychologically in the market? I'd say from that perspective, like you said, we're certainly not in the hedge. So that knocks off one of the three options. We're one of the last two. And the thing about Minsky moments, they need a catalyst, a specific catalyst. And identifying that catalyst is super important if you want to trade or invest around that philosophy. And right now, we don't see the elements of a catalyst to then create the rollover that you saw in that first chart.
Yeah.
It typically comes from an oil shock.
Okay. But the oil shock occurs coincident with markets already being in the Ponzi phase, and that's the thing that tips them over, or just two separate concepts entirely?
Oh, it did. The 2008 recession is interesting because oil prices had doubled over the prior year going to 2008 because of speculative investment based on borrowing from a big source of liquidity. And that did create a recession. So that's actually a pretty good example of one. 1990, oil shock there, obviously not. 2003, market lows, not as much. But the run up in the dot-com stocks certainly feels like a Minsky kind of framework.
I am not referring specifically to any particular publicly traded instrument as a Ponzi, but a lot of people are. And last week, there was a really interesting phenomenon in shares of MicroStrategy, which is a publicly traded company that is using shareholder money to hoard Bitcoin. It's up over 600% on the year. Last week, it became the most widely traded stock in the entire U.S. stock market for at least one day, traded more volume than NVIDIA and Apple, both of which are significantly larger by market cap. I don't know that this is big enough to be a catalyst, but this is the sort of thing that people are pointing to and saying, Minsky. These are people buying convertible bonds with a 0% coupon, hoping that the share price 5 years from now will be significantly higher to offset the risk they're taking and be even better than the return of a traditional interest rate bond. Does that get your attention, or you just look at that kind of anecdotally as its own weird thing taking place and maybe not so emblematic of any particular stage that we're in?
Oh, there were 100 MicroStrategies in 1998 and 1999. There were literally, they IPO'd every
including MicroStrategy, by the way.
Including MicroStrategy. So yes, obviously, I didn't know those stats. Those are crazy. But I think back to, when I was with SAC trading with Steve Cohen, and there were 100 of these things.
Yeah,
floating around every day, and every week there'd be a new IPO that would triple on the first trade. So yes, one is worrisome. It's when you get to scores of them that it becomes, a big problem.
Okay, so maybe when we check in next month, we'll have either less or more than what we have today. Jessica, you're talking about stock market valuations this week, and you're taking a look at the overall S&P and the S&P sectors. What do you see happening here?
Yes, Wall Street analysts have only been 2 to 5% overly optimistic on forward year earnings over the last few years, so they're pretty good at predicting this data. They currently give a $275 per share number, which we think is pretty reasonable, barring a shock. The issue, of course, is what the market's going to pay for that $275 ish number. So we have a fact set chart that shows the forward PE multiple trends over the last 10 years. Again, this is from FactSet, and we put in our annotations, but I have just three quick points here. And the first is that we've only had one brief recession in the last decade, 2 months in 2020, and yet the 10-year range for forward PEs is 14 times to 22 times, which is a difference of over 50%. The second is that the only factor that explains why they move is investors' confidence in the near future. So, as you see in the chart, PEs can be low, like between 14 and 15 times during or after a crisis, like in 2014, 2015, and 2020. Or, of course, when the Fed makes a policy mistake, like in 2018. And then lastly, PEs can reach extremely high levels of over 21 times when fiscal and monetary policy avert a recession, like in 2020 and 2021. So at 22 times currently, of course, PEs reflect very high levels of confidence. So the upshot here is that high valuations and a lot of uncertainty over the next year make it easy to be bearish here. But like we always say, math is not an edge. We do think we have a solid setup going into 2025 with the US economy still growing. We still have solid corporate earnings. And of course, we have a Fed cutting rates. So again, barring an exogenous shock, we're still bullish from here.
When you say math is not an edge, that's because everyone is aware of these numbers and still they continue to allocate to stocks. So just being the one that says, wow, 22 sounds like it's a higher number than 21 or 20, maybe stocks were expensive, that in and of itself is not terribly insightful.
Exactly. Everyone has a calculator.
Okay.
And then we do have another chart on the sector level, if you could please put that up. So given that the S&P 500's valuation premium versus longer run given that the S&P 500's valuation premium versus long run historical norms, we also this shows a FactSet chart with a comparison of sector level price to earning ratios now versus their 10-year averages, and you can see the increase or decrease in forward earnings multiples. We put it in green, which are current multiples higher than the 10-year average, and then also in red, which are lower than the 10-year average. And for real estate, we just used a 5-year average since it's a newer sector. And I just have 3 points here. The first is that, and you can follow along in the chart, the S&P 500 currently trades at a 3.9 PE point premium to its 10-year average at 22 times versus 18.1 times. So that's a 22% difference. But it's important to note that multiple expansion is not because of interest rates here. The 10-year Treasury note currently yields about 4.3%, and its 10-year average yield is only 2.45%. And then second, as you'd expect, as you can see towards the left side of the chart, technology has seen the largest increase in multiples. These stand at 29.2 times today, up 8.1 points or 38% from their 10-year average of 21.1 times. And they're even 4.2 points above their 5-year average of 25 times. So again, despite higher rates, tech has still seen the greatest multiple expansion of any S&P group relative to its long-run average. And then third and lastly, almost every S&P 500 sector is trading about 1 to 5 points rich to its 10-year average PE ratio. You could see the only exceptions are real estate, but barely by just 0.1 PE point from its 5-year average, and then energy, which is down 0.6 points. Both are understandable given recent trouble in real estate and reliance on commodity prices for energy. But the most important thing here is that all the other sectors' ability to overcome higher interest rates suggests investors think structural returns on capital are higher than the average of the last decade. So the upshot here really is that tech has led the pack to higher U.S. large cap tech higher U.S. large cap stock valuations over the last decade, but eight other sectors have helped. So this is not just a tech phenomenon. We really think this is markets discounting stronger U.S. economic growth relative to other regions. And also, we think that global equity investors are increasingly seeing that U.S. large caps have a superior ability to create shareholder value over time. And so they're choosing to allocate to them more and more as a result. And we've seen this firsthand when meeting with clients in Europe over the past few years. So yes, U.S. stocks, U.S. large caps in particular, are expensive, but let's not forget that they've earned this premium over several years, and we don't think that'll change anytime soon.
I was going to say it's like a 15-year period of U.S. large cap outperformance relative to every region in the world, pretty much every major country, certainly. And at a certain point, if you can't beat them, join them. So I don't know how much of this increased PE ratio just comes from overseas flows that want to be in these stocks, but I agree it's got to be some component here. The second thing I would ask you is, when you say it's not interest rates being the reason for stocks having elevated PEs relative to their own 10-year average. So what do you think it is? Is it profit margins? Are people structurally more comfortable with these companies because they're less likely to be wiped out in a recession, given how profitable the starting point is for the way that they operate?
Yeah, we think it's confidence in American tech innovation. We just have massive companies that are globally scalable with tons of cash flows and huge total addressable markets and really strong competitive moats. When we go talk to clients in Europe, for example, they're actually very jealous of the huge tech companies that we have. So they actually see it as a feature,
Understandably.
not a bug.
Yeah.
Yeah, that we have so much exposure to US big tech.
Okay. We did a little bit of work on this that I wanted to just share with you guys and get your reactions. This is Chart Kid Matt at my shop. Took a look at forward PE for the S&P 500. And it turns out that forward PE ratio is still below its previous cycle high. So even though stock prices have made new all-time highs, we haven't yet seen the multiple take out the old highs. So what you can see here on the left is price for the S&P 500. Of course, 6,000 is a new record set the other day. And now look at forward PE, though. In September of 2020, we hit 24.1 times. Arguably, that was versus really depressed earnings as a result of the pandemic. So we are at 22.3 now, which is somewhat lower. I guess my first question looking at this would be, do you think we print a new high on PE ratios relative to 2020 at some point in 25? Or will earnings growth accelerate fast enough to keep us from doing that?
I think my main point here would be 2020 isn't an apples to apples comparison because
Yeah.
we don't have $5 trillion worth of stimulus running through the system.
Right. Okay. We looked at forward PE since 2000. Here, let's put the second table up. So what Matt's pointing to here, valuation, I guess when you look at large caps, look at mid caps, look at small caps, it's kind of a scenario where if you're a value hawk and you're worried that you're buying an all-time expensive PE ratio or a generational expensive PE ratio, well, look at the S&P 400, 16.2 times versus 19 times in 2020. Take a look at the small cap 600, 15.8 versus 18.2. So even though we're tying that cycle high in PE for the large caps, other opportunities have presented themselves. Are you guys thinking that way as well?
Yeah, we do think small caps look attractive here, and we've continued to write that in our DataTrek morning briefing.
got a pretty good rally going as we're talking. So led by, of all things, regional banks. So how do you like that? All right, let's take a look at the U.S. labor market, guys. What are you showing me in these charts?
Sure. So we all know the U.S. jobs market data from this year, but we just wanted to put into historical context to show just how strong the U.S. labor market really is, for two reasons. One, it helps explain why valuations are so high, and it also helps explain why Fed Chair Powell continues to reiterate the FOMC's ability to be patient when it comes to cutting near-term rates. So I have a bunch of charts. I'm going to go through them like pretty quickly. So the first is on initial claims. Yes, so you can see U.S. initial claims for unemployment insurance have been stable for the last 3 years, running at about an average of 220,000. The big stat here is that that's about the same as in 1970, even as the U.S. labor force has doubled in the last 50 years. And the last reading this past Thursday was only 213,000. That's the lowest since 209,000 this past April. And while continuing claims did rise slightly, they're still at 2017 to 2019 levels. Another important point here is that this report includes a reference week for November's jobs report. So it does suggest that the Fed will see a strong labor market reading going into the last FOMC meeting of the year. Then we also have a chart on the U.S. unemployment rate. Yes, so the U.S. unemployment rate at 4.1% is lower than it was during the entire 2000s economic expansion. The only times it was lower was at the end of the last two economic expansions in the late 90s and 2000 and 2019 and 2018 and 2019, or during right after wartime. So Vietnam War in the 1960s, Korean War in the 1950s,
This is an amazing stat.
Yeah.
That we continue to find new lows on unemployment after all this time and all these interest rate hikes. I don't think most people would have expected this.
Yeah, and with such a larger labor force.
Yeah.
Then we also have switching over to wage growth, we have the Atlanta Fed wage growth tracker. This shows that the 3-month moving average of median wage growth is currently 4.6%. That's higher than the peaks of the last two economic cycles. In fact, you have to go all the way back to the late 90s and early 2000s to see higher wage growth than now. I would say on the plus side, at least wage growth was not keeping up with inflation, but at least now it is. Then we also have the ratio of job openings to unemployed workers. So it's currently 1.1 times, which is still one standard deviation above the long run average back to 2000. But it's also the same ratio as in 2018 and 2019 at the end of the last economic expansion. And I think this is a point that's underappreciated. The labor shortage didn't start in the pandemic. It actually predated the pandemic starting in 2018. But for almost 2 decades, from 2000 to 2017, there were always more unemployed Americans than jobs available. And that's certainly still not the case now. And then lastly, we have quits as a percentage of the labor force. If you couldn't, there it is. So this has fallen quickly from a record high of 2.8% in 2022 back to the long run average of 1.8% since 2000. So people are now quitting at normal rates. However, the next chart, layoffs and discharges as a percentage of the labor force, is historically low at 1.1%. That's even still below the 1.2% print right before the pandemic hit, when the U.S. economy was super strong at the end of the last economic expansion. So while Americans are staying put with less confidence of finding a better job, employers are reluctant to lay off workers, given a still decent economy and how difficult they were to find and costly to train during the ongoing labor market shortage.
Yeah, people. Let's go back to quits really quickly. So for the listeners, we're at about a 1.8% quit rate. At the peak of the quit rate, which was April of 2022, it looks like, that was about 2.8%. So they don't sound like huge swings, but this number is remarkably stable over long stretches of time. And again, the average is 1.8%. So that 2.8% quit rate was really aberrant. And it was just at this moment where we weren't sure, like, were people ever going to go to work again? Was everyone going to start their own company? So now getting back to normal was not even painful because we're just at normal now. I don't think we don't want to see that number crash again. We're happy with where it is right now if it could stay here.
Yeah, and the Fed's super happy with it because there was such high turnover because people were finding better paying jobs, which was pushing wage growth higher. And people, of course, wanted more flexibility with either remote or hybrid work, which actually leads to, I just have two more charts that show two high frequency labor market data points. The first is on U.S. office occupancy. U.S. office occupancy is still only about half of what it was pre-pandemic. So workers put the most face time in on a Tuesday, with occupancy reaching between as high as maybe 65% in New York to 75% in Austin. But on Fridays, you still only see about a third of occupancy. And then if you look at U.S. Google search volumes for remote work, they're still at 5-year highs, or they just made a 5-year high, which is pretty remarkable. So clearly workers still have a strong desire for remote work, but even more importantly, they continue to feel they have the upper hand versus employers in keeping either hybrid or remote work. Otherwise, they'd show more face time in the office. We continue to think that this dynamic isn't going to change until we have an impending recession whereby workers trade job flexibility for job security. And just wrapping this up, the reason why we think this is so important is because such a strong labor market pushes interest rates higher without sustainable productivity growth, especially with such high wage growth that feeds into overall inflation higher than the Fed's 2% target. And that's why the Fed Chair Powell wants to keep rates still somewhat restrictive and not cut them too quickly, because he wants to see the labor market continue to cool so that inflation moves sustainably lower.
Yeah, I think that's the really important point. If you're modeling for next year, and we don't have an interest rate forecast, but just hypothetically, for someone that does, you should probably err on the side of less cuts versus more, purely on the basis of the state of the labor market. It's still incredibly strong. So what would be the Fed's rush?
Yeah, and you've seen Fed fund futures pull back their expectations too. They now only think there's going to be 2 to 3 cuts over the next 13 months.
Okay. Nick, you want to get to the biggest market caps now versus the 90s? What's the big message here?
Yeah, so when we look at long-term PE charts, like the one that we were discussing earlier on this podcast, it assumes that the quality of companies is the same all the way through.
Which it is not.
Which it is not. So let's throw up the table here. So this shows the 3 largest companies in the S&P in 1995. When I was at First Boston, I would be sitting on morning calls, and the guy who covered these companies always got to be on the morning call first because they were the most important companies to the S&P, the highest quality U.S. companies, and you can see they are GE and so forth. And then we have the same companies today.
For the people listening, ExxonMobil and Coca-Cola.
Right.
Okay. Got it.
And then now we have the same companies in 2024, NVIDIA, Apple, and Microsoft. And what this chart shows is it breaks down the fundamentals of these companies. What do they make per dollar of revenues? How much do they turn over their asset base and revenues divided by shareholder equity? So the ROE component, then their ROE, and the percentage of non-US revenues. So how international is the company and how does it make in terms of return on equity? And the comparison is quite striking because the companies in the 90s were perfectly good companies, excellent as a matter of fact. And so they averaged an ROE of 31%. That's great. They had margins of roughly 10% and turned over their revenues to shareholder equity about 3 times. So very fine companies with 59% non-US revenues. So very international, very profitable, very good return on equity. But then you fast forward to today, and you got NVIDIA, Apple, and Microsoft, and their net margins are 36%, so 3 times the best companies in the 1990s. Their revenues to shareholder equity are about the same, 3.1 versus 2.9, but because the margins are so much better, the ROE has gone from 31% in the 90s for the best companies to 89% today, and as high as 165 for Apple. And they have roughly the same percentage of non-US revenues. So the direct comparison tells us that the market values big international companies. Okay, great. Both sets of companies have that. Yep. And then it measures ROE. And on that basis, the companies for today are materially, like way better than the companies of the 1990s. So naturally, valuations are going to be higher. So thinking about PEs as a constant over time, that's not the way it works. Markets value ROE and they value growth. And the companies today are just simply light years ahead of the companies in the 90s. And
Sure. Do you think this is the thing that the CAPE ratio people of 2010 and 2011, who just insisted that we were at this 90th percentile in the cyclically adjusted PE ratio, the 10-year PE ratio, do you think that this is the thing that they missed the most or most underestimated, was how much more people would be willing to pay for today's giants versus yesterday's? Because I do.
Yes.
Okay.
Yes. And it's not just that. I mean, the CAPE ratio is a very interesting measure because it goes back to the 1880s. So it gives you this comforting sense of a long-term historical perspective. But if you look at it over time, you see it just tends to go up over time.
It's got a tilt. It's got an upward tilt over time.
It's got an upward tilt because it's just philosophically hard to compare the S&P of 1900 based on railroads with the S&P of today based on global internet and global technology. Yeah. To me, it's not just that it's a cooler technology, it's that the fundamental business models are much better. A higher ROE, much more judicious use of shareholder capital, much higher margins. And so you end up with, I think, that's where the flaw of any kind of historical PE analysis really comes to the fore, because you're comparing companies historically versus companies today. And we happen to have a batch of companies today that have incredibly high ROE, and shareholders should want to pay more for that.
Yeah, I think because of what you're showing me here, the biggest risk factor is anything that comes along and materially threatens profit margins, especially within large cap, consumer discretionary, large cap technology companies. Like if you're looking for the meteor that's going to hit Earth and wipe out the dinosaurs in this era, that's really the thing. Like what is the thing that all of a sudden comes along and threatens these kind of structurally higher and very well protected moats and margins? And I don't know what maybe you would have thought Lena Khan at the FTC and a very progressive sort of populist left wing winning a lot of court cases, but that moment seems to have passed. And I feel like you can see that in the stock price action over the last 2 weeks.
I think, it could end for 2 reasons, aside from just, a financial crisis or something else that affects liquidity. The first is if you got competition from overseas. If Europe had as vibrant a tech industry as the US does, US multiples would be lower. So they don't have their own Microsoft. They don't have their own Amazon. They don't have their own Google. They use the American companies. If China had a different regulatory regime and actually encouraged global growth for its tech companies and could firewall them sufficiently politically, that'd be a threat. But neither one of those 2 things are happening. And neither one of those 2 things seem likely to happen in the next decade. It takes too long to build these companies. So that could be a thing. Yeah. The other one would be a disruptive company getting funded right now with venture capital that eventually takes over Google, for example.
Right.
And the plus side there is it's probably US and it probably ends up in the S&P. So you're hedged.
Yeah, it's OpenAI or it's Perplexity. Those are your privately held Google competitors that, yes, I suppose it's possible. In 2003 and 2004, Google looked just as unlikely to be able to dethrone Yahoo. So these things do occasionally happen. Tough to bet on because so many times it doesn't happen, but you're right. It's definitely a threat. I would just point out one of the things about these companies that have these incredibly high margins is it allows them to experiment a lot. It allows them to cannibalize their own business. It allows them to throw a lot of money at projects that may not work because they're not preciously conserving a 5% profit margin. So Netflix being a really good example, 2 years ago, Wall Street told them they had to change something. They came out with an ad-supported platform that would have been a heresy in a prior era to have a company eat its own business, and yet they're actually more profitable on the ad-supported tier than they are on the premium tier. This is something nobody could have imagined in 2022 when they announced that they would try it. You can't try it if you have no margin because it's every quarter is about survival. When your gross margins are 20, 30, 40%, you can try a lot of things, and that helps you sustain your moat, which, of course, equity shareholders are now willing to pay more as a result of that sustainability. Any thoughts?
Yeah, that feels right. And competitive advantage is what drives valuations.
Absolutely.
And these companies can have proven they can persistently improve their competitive position, or at least maintain it and grow at the same margin level they have historically. So it's just a very powerful combination.
Have I told you guys lately that you're the best? Has it been too long? I love catching up with you both. Your research is incredible. I want to tell people that they can follow your YouTube channel, your youtube.com/@Nick Colas and Jessica Rabe. And of course, you can go to DataTrekResearch.com to get all things Nick and Jessica. You guys are publishing every day, doing an amazing job. Thank you so much for joining us here on The Compound. And we'll see you next month.
Thank you.
Thank you.
Thank you, guys.